Last month we saw volatility return to equity markets, and once again it was largely due to rising trade tensions. Donald Trump announced via a tweet that the US would be imposing 10% tariffs on a further $300 billion worth of Chinese exports, and this sent markets downwards. They have partially recovered since then though, and despite the sell-off at the start of the month, it's still been an above-average year for global equity markets, with the MSCI World Index up more than 14% since the start of January. Something which has been on a relentlessly downward trend this year is bond yields. At the start of the year, UK 10-year gilts were yielding around 1.25%, which is already quite low. But they've continued to plummet this year, and at the moment those 10-year gilts are yielding just 0.4%. Rates are even lower elsewhere. For example, last month in Germany, the government managed to issue a 30-year zero-coupon bond with a negative yield for the first time ever. This means that buyers have lent their money to the government, they're receiving zero coupons on it during the lifespan of the bond, and when it matures in 30 years' time, they receive less than they paid in. So, in other words, they're paying the government to hold their cash for them, and they're not receiving any interest on it. With the downturn at the start of August, most equity markets were negative last month. The FTSE 100 index was off 4.1%, the S&P 500 index declined 1.6%, and the Euro Stoxx index was down 1.1%. Emerging markets also struggled, with the MSCI Emerging Markets Index losing 2.5%. And in the FX markets, the pound ended the month flat against the US dollar. However, it took another hit earlier this week, and yesterday it reached a 34-year low against the dollar. With Brexit and the possibility of a general election dominating the headlines at the moment, there are very high levels of political uncertainty affecting financial markets. Since the downturn last month, we've maintained our equity exposure and our foreign currency exposure at relatively modest levels, whilst monitoring the equity market and the options market for value opportunities.